Hello, everyone. I'm Mayur Thaker. I'm an equity strategist and the portfolio manager for the Zacks Earnings Certain family of portfolios. And this is an important quarterly update on the strategy, the philosophy behind it, and a little discussion on the recent performance of the portfolio and a little highlights on the key holdings. And there's a very important announcement that I would want to make in this video as well. And we'll get to that a little bit later here. So let's get started. So let's talk about the strategy itself. What we do is we want to buy quality, fundamentally quality companies. Number two, we want to do some valuation work to make sure that we're not overpaying for those equities. And then number three, and this is new, we want to manage risk going forward. This is a new principle that we didn't have before, but I wanted to introduce it here today and going forward that managing risk is an important part of the investment journey that we're all making together. And so even if we put, forth our best foot forth on identifying great businesses to own, and even if we do our due diligence in finding companies that are not overvalued, in many cases appear to be undervalued based on our framework of thinking, sometimes we're just flat out wrong, right? And that's okay. So what we want to do is start to manage the risk. So in case that we are wrong about a thesis that we put forth on a company, we don't want to continue making that mistake over and over by holding that same company. And so what I wanted to do here is introduce a third principle of the earning certain strategy, and that is to manage risk. We'll talk about exactly how we do that. But first, what is quality? Quality is consistency and durability. That's really it. What is consistent? What do we mean by consistency? We look for consistent earnings per share growth, consistent free cash flow conversion, and consistently attractive returns on invested capital. Because combined, these factors tell you that the business's past financial performance and management's ability to allocate capital and the sensitivity to past economic cycles are very, very much, sturdy. So what we want to do is make sure that that was the case, at least in the past. And then what about looking forward? We want durability. We want evidence of the business being durable, right? Does the company make critically needed products and services? Do they solve a pain point, or do they cut costs, or do they increase utility? Do they have recurring subscription or long-term lease revenue contracts? Is there brand value there? Is there a special product experience or better customer service? Does the company have strong capital allocation? Are they investing in themselves? So these are all questions that we answer for every company that we analyze and add to the portfolio's holdings. We can say with confidence that yes, it meets or at least checks off at least two of these five boxes here. So combined, these factors tell you about the business's ability to continue the past high performance into the future. So this is the flywheel, right? We look for companies with earnings linearity, right? That means our consistent earnings per share growth. We look for companies that demonstrate high returns on invested capital. Remember, companies that can do this sustainably, meaning companies that earn high returns on invested capital for long periods of time, let's say more than 5 years, tend to also be sitting on an economic moat, right? In the form of brand value. They have specialized expertise in a field that they're working in. They have economies of scale that's very difficult to compete with. They have network effects, which are also very difficult to compete with. So these things together, at least one of them, creates high barriers to entry. So that what that tells us is that it gives us greater confidence in our selection for the long haul, meaning this is a company that has been able to perform well in the past, but because they have a economic moat, that gives us greater confidence that they can continue that high fundamental performance into the future. So we want linearity, right? Companies that demonstrate high linearity means that they're providing a product or service that's critically needed. It's an essential, not a nice to have, not a discretionary. That gives us insulation from economic shocks, from economic volatility, from macroeconomic uncertainty, like the times that we're in right now. And so that's why one thing that we can say for sure is that our companies continue to generate consistent earnings per share growth, even in the face of high tariffs and other trade wars and other geopolitical tensions that are going around the world. Our companies continue to generate results year in and year out. That gives us a lot of fundamental confidence that the companies that we're picking are not only companies that have an economic moat with the high ROIC, but also companies that are economically insulated from shocks. And then number three is we want free cash flow conversion. This is important because remember, the first two are based on accounting principles, GAAP accounting principles. Oftentimes, there are ways that companies can massage earnings. Earnings per share is a great number to analyze business performance, but it can be manipulated with because of the fact that earnings are an accrual item. It's not a cash item. So earnings can be artificially inflated with accruals such as receivables. It can be also manipulated in other ways too. So the reason why we have free cash flow conversion is that gives us sort of a BS meter. Are the earnings that they're reporting real? Free cash flow is very hard to manipulate, much harder than earnings are. And so free cash flow must be backing the earnings that are basically the basis of earnings linearity and a return on invested capital. So if we have high linearity, high ROIC, we also need to see those earnings being translated into free cash flow at a high rate. Usually that number is around 80%. We target that. Sometimes it's a little bit less than that, but that's okay. But 80% is what we like to keep the portfolio average above. So meaning earnings, meaning the net income must translate into free cash flow to roughly 80%, meaning free cash flow should be at least 80% of the net income that they're reporting on the income statement. That's very, very important to give us confidence that this is a cash producing machine, not just an accrual accounting machine. When free cash flow falls too low, we move the company out of the portfolio, we put it into the too hard pile because that means that we need to put our forensic accounting hats on, and that's just too much work, right? And there's many other companies that are just as good on linearity and ROIC. So why not swap in for those companies that don't have those cash flow concerns? And then, of course, there's growth, right? And growth is kind of tied, at the hip of linearity. They kind of move, in unison with one another. So, but, we don't like to chase high growth. We don't like to go after companies that are growing 30, 40, 50%, because that often means that those companies get overvalued very quickly. And so when that growth inevitably slows, which it will, those companies will go through multiple compression. And that is usually the bull trap that a lot of investors get stuck in. So we don't like to chase high growth. We like to stick to the 5 to 12% earnings CAGR range. That's kind of the sweet spot, because at that level, that's a level that companies can sustain for many years, possibly a decade plus. And so as long as we have the other, planks of the strategy in place, companies that can sustain 5 to 12% earnings growth tend to be able to deliver the greatest long-term returns to shareholders. So this is the flywheel that we like to target, the flywheel of shareholder value creation that the Earnings Certain proxy is built upon. So we like to make sure that no matter what we do in the portfolio, this is our framework of thinking. This is our process that we follow, and let the results come as they may. but this is our due diligence that gives us supreme confidence that the companies that we pick are fundamentally sound. They are, protected by an economic moat, and are insulated from economic variability and volatility. So that gives us a great amount of confidence. So the key word here, the key underlying theme is consistency. That's why we call it the earnings certain portfolio, because it's consistent. And here is that certainty. This is what that certainty ultimately looks like. You can see earnings growth is extremely stable over time. We are not sensitive to economic shocks and volatility. And here you can see on this next chart, compared to the S&P 500 earnings growth, look how stable our growth is. So it's not only stable, but it also compounds faster over time. This is, of course, because we're factoring in the 2008 Great Financial Crisis. We just simply, since we incepted the portfolio in 2012, we really haven't seen a true economic downturn just yet. Not because COVID was too short, and we fought that with trillions of dollars of quantitative easing and zero interest rates for a long time. That was one of the shortest recessions on record. I believe it was the shortest recession on record. So we just didn't really allow that recession to play out. And so there really was not much of a downturn in the market. That was more of a crash, followed by a robust recovery. So, I believe that, the true value of this portfolio will show when we have an event like 2008, or even if it's not as severe as 2008, when we have an event like the 2001 dot-com bubble that burst, that recession that followed, which was much milder than the 2008, great financial crisis. Unemployment, remember, was not that high during the 2001 dot-com crash, right? Or bear market, I should say. Unemployment reached 10% in 2008. That was a really bad time for, a lot of people. The 2001 recession was really not that bad. In fact, we didn't even have, most people don't know this, but we didn't even have 2 consecutive quarters of negative GDP in 2001. And yet that downturn in the market was almost as bad as the 2008 downturn in terms of the total drawdown of the S&P 500. So even if we get a period like 2001, I believe that the true value of the earnings certain strategy is going to show, but we just haven't had that yet. But I believe that day will come. Eventually that will come, and when it does, that's when our portfolio will really shine the way that it looks in this chart right here when you count the impact of the 2008 downturn there. So you can see that our portfolio has not only steady earnings growth, but faster compound growth in terms of earnings over time. That is the whole idea of this strategy. This is what we want. We want not just steady growth, but we want faster compound growth over time when you count the impact of a cyclical downturn. So, and this happens because the S&P is a hybrid of two types of companies. There are cyclicals, and then there are true growth companies. So what we do is we isolate the growth companies and we get out of the cyclicals, because remember, cyclicals are roughly half of the S&P 500 index, meaning half of the companies that are in the 500, 250 or so, are cyclicals, meaning they are not companies that grow over time. They're mostly cyclicals, meaning they go up and they go down with the business cycle. They are low ROIC companies, primarily cash cow businesses that don't have a lot of growth because they don't have many investment opportunities. However, index investors own them 100% of the time, right? If you're an S&P 500 index investor, you're forced to own companies that don't grow over time. They're not great long-term compounders. The other half of the S&P 500 is where all of the gains come from in the long haul. That is the secular growth companies, the companies that continuously reinvest their cash flows at high rates of return to grow. This achieves compound growth. So compound growth comes from a relatively small portion of the S&P 500. I would say it's roughly half, and lately it's been even less than that. So a small handful of companies, a small percentage of companies really define the vast majority of the returns of the index. So what we do is we remove the cyclicals. Why own cyclicals all the time? It doesn't make sense to do that. Because look, this is what cyclicals look like. Mosaic, Freeport-McMoRan, ExxonMobil, General Motors. Why do we own this for long periods of time? It doesn't make sense. Because that's what the index does. These companies, they don't grow over time. They have earnings that go up and then they go down, up and down, up and down. And over time, it's just sideways. So there's no returns over very long periods of time. These are dead weights in the portfolio. So we remove that and we focus in on the long-term compounders only. Why own cyclicals all the time when you can own the compounders continuously? Because they continuously grow, which means their share prices continually appreciate over time. That's the whole idea of the Zacks Earnings Certain proxy. We isolate the compound growth aspect of the index. And also since we overlay other fundamental factors like ROIC, excess ROIC, as you see here, free cash flow return on investment, the higher this is over time, the faster the growth and the better the capital allocation. And so this is how we achieve better compound growth over time. So the S&P 500 has two sources of risk, right? We have earnings risk and valuation risk. Earnings risk comes from business cycle risk, like what happened in 2008 or even in 2001 or other past recessions. Earnings go down, that's earnings risk. But also we have valuation risk, right? When the market is priced for peak earnings growth, but then earnings don't come in as expected, then valuation resets as well. So that's a double whammy, right? We have earnings go down, which drags down the S&P, but then the multiple that the market trades on those earnings also compresses. So that compounds the effect of the downturn. So what we try to do is it's really hard to mitigate valuation risk. However, we're starting to do that now with this new factor that I'm about to tell you guys. But the core fundamental model that the earning certain portfolio is built on attempts to eliminate risk number one, right? Because we don't have earnings risk. If you go back to this chart, these are the companies that we own. These companies don't have earnings risk. They certainly have valuation risk, right? And that's why we do see that our companies do go into bear markets on occasion. In fact, quite often. But that's a factor that we can't really control, right? We don't have direct control over that. What we do have direct control over is the types of companies that we select. And so these companies do not have a high level of earnings risk. So that eliminates a very large source of risk by removing that earnings risk. The valuation risk remains, but here's what we're going to start doing to mitigate even that second risk there, the valuation risk. So as just a recap, right, the Zacks Earnings Certain proxy exhibits linearity, attractive returns on capital, high free cash flow conversion, long-term sustainable earnings growth rates, and it's rooted in identifying companies that provide critically needed products and services, right? All of these factors together help us eliminate that risk factor number one, earnings risk. So that's a big source of risk that we just took off the table. So let's talk about, what we're going to start doing here. So these are just a couple of the companies that we own in the portfolio. Very, very high quality companies for the long haul. Let's talk about performance now. This is what's on everybody's minds. All this sounds good on paper, but look at the performance. It's been really bad, and I'm not going to talk, around it or sugarcoat it. The performance has been really awful, but check out, really since when that started to happen. We, as a defensive portfolio, we were actually doing really well up until I want to say right around 2023. Just about 2 years ago, we were neck and neck with the market. And that says something a lot. That says a lot because remember, you might say, well, what's the point? Why not just own the S&P then if you're going to do the same performance? Remember, this is a portfolio that plays defense first. This is a high quality, low beta, low volatility portfolio that removes risk factor number one. Remember, we don't have a lot of earnings risk. And so we're generating matching returns to the market with substantially less risk, right? This is a low beta portfolio, an aggregate beta of 0.8, right? And that's a low beta, low volatility portfolio, and yet we are matching the S&P's returns during one of the greatest bull markets that we've ever lived through. So that says a lot about the returns of the portfolio up through roughly Q1 of 2023. But really, since then, there's been a market separation in performance here. And the reason for that, has been twofold. Um, what has been the key driver of that? Here you can see the annualized return since inception, 12% for our portfolio, 14.87 for the S&P 500. So we're doing quite well as well. I mean, 12% is not that bad at all, but versus the market, yes, it's been a significant underperformer. Q3 got really awful. We were down 1.3% in the quarter. The S&P ripped off an 8.1% quarter. Truly amazing. Year to date, we're up only 2.75%. The S&P is up almost 15%. It's just insane differential there. Probably the biggest differential that I've seen, in the last, 12 to 13 years that I've been involved in this strategy. And the 5-year annualized return, again, a big difference there, 9.78 versus 17. So what's been the primary reasons for that? The primary reasons for this underperformance is we are and continue to be underweight big tech when a majority of the index's returns have come from just 8 companies, which are all mega cap technology. These 8 companies are basically the Mag 7 um, plus Oracle, right? These are just 8 companies. That's been, what has explained the majority of the index returns. Um, I've seen other metrics where, the top 10 holdings of the S&P are almost, 35% of the index now. And that is unprecedented. That's never happened in the history of the index. This level of concentration represents a significant source of risk that investors really should be aware of. Most people buy the index thinking that they're diversified. Well, they are diversified, but they're diversified to the lowest extent in history because the index is now dominated by just 8 companies, or just 10 companies, really. That level of concentration has never happened in history. And it's all from one sector. If these 10 companies belong to 4 or 5 different sectors, that would be one thing. But, all 10 of them are from one sector, technology. And we continue to be underweight big tech because it just doesn't satisfy our criteria. So we're going to sit this one out, kind of like how Warren Buffett sat out the dot-com rally. Berkshire underperformed significantly versus the S&P in the late 90s. So we look a lot like Berkshire right now, as Berkshire did back then in the late 90s. Everybody wondered what's the point of sticking and investing with Warren Buffett when the Nasdaq is up 5% every single month, right? What's really the point? That's kind of what is happening now with the ECP. Um, However, we've also had our own source of, our own little, problems. FactSet, one of our holdings, is down 40% year to date. Fiserv down 31, Novo Nordisk down 34. If we had avoided just these 3 companies, if we had avoided them, the strategy would be neck and neck with the S&P this year at roughly 13 to 14%. Um, So that's a lot of concentration in just three companies. Just three companies really weighed us down significantly this year. Because remember, we actually had a couple of really big winners this year. We own Oracle in the portfolio. Oracle is up an astounding 50% this year, so that's incredible. Um, and we've had a couple of big winners too, but they were offset mostly by these three big losers here. Um, so what are we doing about it? Right? What are we going to start doing about these types of big losses in the portfolio? We are adding a fifth criteria, and that is momentum. So recall that the Zacks Earnings Certain Proxy strategy was originally built on just quality, right? Now we're introducing a fifth, and that is momentum. Momentum can be defined in many different ways. We're leaving that open-ended here, but just to give you a couple of examples of the types of indicators that we're using, we like to look at long-term moving averages. That's the 150-day or the 200-day moving average. The monthly average true range. This is a technical indicator. We're starting to take a look at that as well. The monthly RSI when stocks. RSI is actually a great indication of momentum. Monthly MACD also is another indication of momentum, or any combination of the above. So in addition to identifying fundamental quality, from now on, we're only going to hold names if the momentum is bullish, meaning if at least one of these indicators are bullish, that's what will keep us to continue holding that name in the portfolio. But when a stock falls out of favor, we will remove it from the portfolio and replace it with another company with similarly high quality fundamentals, but with stable or bullish price action, meaning we will swap them for another company that demonstrates robust quality according to these metrics here, just as good as the company that we're removing, but also one that has bullish momentum, right? Because why own a company even if it has high quality? Why own it if there is no momentum? If all of our indications of momentum are bearish, and remember, we're using monthly indicators here, monthly, or long-term daily, the 200-day moving average. These are not short-term indicators. They don't change every day or every month even. Usually when something flips bullish, it stays that way for several months, 6 months, 12 months, up to several years, in fact. The monthly average true range, when that goes bullish, in many instances, in several dozen instances, it stays bullish for multiple years. So this helps us identify the macro trend, the big picture trend. Is this a company that is in a bullish super cycle or not? This is an indicator that helps us identify that. And when they fall out of favor, when it breaks down, usually it doesn't break down often. Sometimes, in many cases, like in the case of Novo Nordisk, the monthly average true range went bullish all the way back in 2011. Um, and it just broke down bearish as of this year. But we're continuing to hold it now since the damage is already done. We think Novo Nordisk is a great buying opportunity now. But had we practiced this principle earlier this year, in fact, I believe it broke down in December of 2024. So had we sold in December of 2024, we would have actually avoided, this negative 34% drawdown entirely. And now we would be looking to buy it back because it's a very, very attractive buy in our opinion now. So we're not selling it now, even though our momentum factors are bearish, because it's now at an attractive valuation and the core fundamentals, the core quality factors all remain intact. So if anything, it's a buy now. So we're not removing it from the portfolio, but if we had identified and deployed the strategy originally, we would have sold it, and avoided a 34% loss in that position. So what we're going to start doing now is when momentum falls out of favor for a company, even if the quality is still good, what we're going to do is we're moving it to the too hard pile and swapping it out for a company that has just as good high quality fundamentals, great growth prospects, robust linearity, returns on invested capital, free cash flow, but also have bullish momentum. So we expect this momentum factor to introduce greater turnover to the portfolio, approximately one change per month for the three portfolios that we manage here. One change per month. So we don't like this increased turnover. Trust us. We don't like turnover. We like to have high quality companies that we own for the long haul. We like to we like to harness compound growth over time. That's been how we generated these results since inception. But we believe that this is a trade-off that is value accretive, because we do expect that this is going to significantly improve our performance. And so far, it actually has started to pay dividends. Here is a chart of the changes that we've made in the last 3 months, which is when I actually started using these momentum factors. And here you can see in green are the ones that added value, the changes that we've made that have added value so far, and the red are the ones that have not added value so far. But you can see that the red here are relatively small. They're not really that bad of a decision. But here you can see a couple of big ones that we've made. For example, we removed Gartner from the portfolio, ticker IT, on July 31st. And as you can see here, as of July 31st, we removed it. And look at the return in August, down 25%. It bounced back 4% in September, and it's down another almost 10% so far this month in October. This is through the 17th of October, down another 9%. So that was a great decision. Similar with Pfizer, down almost 13% since we removed it on that same day. We removed Accenture just last month on September 30th. It's down another 4%. So these were some of the good decisions we've made. Other decisions haven't turned out well, at least not yet. We'll see how they turn out with more time. But we don't expect every removal to go down and every addition to go up. But over time, we expect that the small handful of winning decisions as a result of this new momentum factor to significantly outweigh the other decisions for a net increase in alpha. That's our expectation. So, we remain very optimistic about the long-term performance of the strategy. I really believe in this approach. I really believe in the core fundamental framework that we deploy. And I'm actually even more excited about this new momentum factor and the alpha that will start generating for us. So I believe that we should stay on course in the long run. Those who generate the steadiest earnings growth will outperform. And with our risk management that we've started to deploy here, I think that the returns are going to be even better going forward. So I really appreciate your time. Thank you for attending and watching this if you've lasted this long. Thank you again for bearing with us, but I still think that the best days of the Earnings Certain family of portfolios are ahead of us. And someday, I hope, and I still believe very strongly that that our approach will win out in the long run. And I'm even more optimistic that that's going to happen with the new edition of the risk management, principles that we are starting to use now. So thank you again for attending. If you have any questions, I'd love to hear from you. Please do reach out to us at 1-866-794-6065 or send us an email to zrs@zacks.com or strategycall@zacks.com. Thank you so much and talk to you soon. Bye.